Calvin Williams, man, it's great to get you in the chair and have a quick conversation, man. We've known each other for a while, going back to what, early 2000s?
Exactly.
And love to just give a sense of like, what's your background story?
Yeah.
Start with the origins of Calvin.
Yeah, so for me, it always starts back in Maryland. That's where I was born and raised. Was in technology and finance, like even as a little kid. You know, I first started, like I bought my first share, and I remember it. It was on Share Builder. I don't know if you remember that.
I do remember.
Yeah, they were bought by Capital One.
Wow.
And I was like 12 or 13, and I bought my first share. And then, you know, I'd always been around technology, building websites for companies in middle school and high school. And then I was recruited to work for the Department of Defense when I was 17. I don't know if you remember the movie Enemy of the State with Will Smith. I thought it would be more like that, you know? But actually it was like, I'm like 4 stories below ground,
Right.
like
In the
in a basement. I was like, this might not work for me long term. It was great work, great people, but I wanted something else. So came down here, which is when we connected at North Carolina A&T, launched my first startup. We were successful with building websites and web apps. And then I sold that to my partner thinking that I was having some money because I had done what I thought I was supposed to do. I had bought my first house at 20. I had a retirement account at 16. So I'm like supposed to do the right steps.
Knocking
you know?
all
Exactly.
ticking all the marks.
Exactly. Until I go try and talk to a wealth manager. And I'm like, hey, I want you to help me build my wealth. And he's like, well, you don't even really qualify for a phone call unless you can deposit $1 million. And it was at that moment I realized I was still broke. Like I was not doing as well as I thought. And that's what kind of set me down this path of Freeman Capital. Like how can we give people exactly what they need when they need it to help increase their net worth? And that's what brought me to here.
Interesting. So we share a number of things in our background. One was the love of technology growing up. So I grew up in an entrepreneurial family, 3 generations of entrepreneurs going back to the 30s. But we were all gearheads, right? You know, mechanics, and my family had several companies that all were around mechanics, electrical, HVAC, that sort of thing. So coming to A&T was a new experience for me. And you talked about how your first business, and I remember when you were building websites for companies and that sort of thing. My first company was born right out of A&T as well, right? Core Services, Inc. was around doing computer-aided design and computer-aided engineering for large manufacturing sites. Actually came out of an internship that I had after junior year, and we spun it out into a company and sold it a couple of years later and got involved in what's called tech transfer and commercialization. So taking those innovations and inventions out of universities, and then either spinning them out as startup companies or licensing them to larger companies, and going on from universities to federal laboratories, NASA, Department of Energy, and others. But also having several startups along the way, and that's where we're going to pick up on on where we are. So you talked about the major issue around wealth building that was the catalyst for Freeman Capital.
Right.
Tell us a little bit about the company now, after the origin.
Yeah, so I think that, you know, and as you know, as a startup founder, you have a vision of what you want it to be, but that journey may twist and wind a little bit. And, you know, we started with this vision of like, oh, well, people are already investing, so we're just going to like augment to a different investment class, a different asset class. And we did that for a while, and we were actually, as far as we can tell, and we worked with the regulators and they didn't tell us no, but we were the first automated platform for currency, like like the currency markets for retail customers. And people were using it. They were, satisfied, but they wanted to give us their whole retirement plan. And the currency market is not a place to put all of your money in.
Not at all.
Exactly. Like, maximum a couple percentage points.
Right.
But that was a really interesting thing because we learned from the market that we had something there, like we were close, but it wasn't all the way there yet. Yeah. And so that's when we sat back as a team and saw, okay, when you look at the financial service market, when you look at the new American majority, which are going to be people of color in the next 40 years, where are the disconnects? And what we saw was that the robos have, they've dismantled all profit margin from managing money. There's none there. Then you have firms like Robinhood and Acorns who have destroyed the commission-based business. There's no profit there, right? But when it comes to financial planning, that is still a segment of the market that's been reserved for those who have money. Yeah. The average cost is $235 an hour to get an advisor. And then you couple that with the wealth gap. Here's an opportunity to use technology and innovation and a brand that makes folks feel safe and comfortable to help them build their wealth, and that's what we've been doing since.
Excellent. That disintermediation of the industry and being able to eke out where you can create some efficiency for possibly even a different audience that never took advantage of.
Yeah, so there's two things there. There's the difference in the product and the difference in the market. And so we think that's why we've been hitting some success, some early success, and why we've been having some fundraising success as well.
Yeah. Let's talk a little bit about the industry a bit. FinTech is really took off in 2015 and has continued to experience meteoric rise and growth. But there's unique challenges in terms of when you innovate within a highly regulated industry. So, and I know we share this because when we reconnected, when I moved back to North Carolina, of course I had the fintech company Cathedral Leasing. And,
I remember that.
And so we could talk about the regulatory environment, but talk a little bit about how you've been able to navigate a startup in a highly regulated industry and staying in between the lines, but also destroying the lines at the exact same time.
And not having equal funding to go do that, right? So point. There was a friend that I was talking to, and he's in a kind of a regulated space too, and we said we picked some of the hardest industries to learn. There are a lot of easier ways to make money.
Absolutely.
But I mean, it is so true because virtually, for us, when we're dealing with consumers funding and their own money, their retirement, there's so much regulation that we have to stay on top of. And fortunately, I'm just kind of weird where I enjoyed reading all of the rules. You
were reading the
yes,
whole
I was. The whole entire
system.
thing. And I don't remember this, but at A&T, when I ran for student body president, I read the whole handbook, right? And so I campaigned in a way that was right in the rules, but then later on they changed all of the loopholes that I found in the next campaign. So I have a passion for just just reading and really understanding that. I mean, it comes from my mom and kind of her interest in law as well. And so for us, what we've had to always do is understand what is the framework of the law and the regulation, and then what is the intent of the regulation as well. And then understanding how has technology advanced beyond the framework as it was currently designed, and then how to take that and bring it to a retail person who's been ignored in the market. So it's kind of like 3 levels of chess that you have to play. First, understand the basic regulation that we just have to follow. Because as you know, we get audited. They come in and they check us out.
Absolutely.
Then it is understanding how will technology let us put a different business model or implementation model into the framework that exists, and then how to target that service to a group that has never been served.
That's right.
That's
so there's an education layer on it. Absolutely. One of the you've had in building Freeman Capital, you've had a really unique experience in terms of raising capital from day one. And this goes back to what you said a second ago, particularly in fintech, when you're working in highly regulated industries, it's really important that you're capitalized well in order to deal with the challenges that you're going to face.
Just for compliance.
Right? Exactly.
Just compliance
for
legal.
compliance alone.
Exactly,
Right. Yeah. So can you walk us through your capital raising experience from the very beginning? And when I say from the beginning, as you were beginning to determine what your capital requirements were.
Yeah.
And then how you raised that capital over time.
Yeah, so at the beginning, it really started with being self-funded. So I was still employed at this time, and I had had a talk with my wife, be like, hey, I want to start taking money out of our house to put into this idea.
Yeah.
And you know how those conversations go. And so she was like, hey, before you like spend any real money, like, you got to validate that this idea is real. And so the first thing that I did was I paid a couple bucks to get a market research study done. Like, I hired someone who's not impartial to me, because we will see the way that we want to see it, but I wanted to hire someone to really validate that there was a market there. And as soon as that was done, then what happened was that I took virtually what worked out to be half of my salary, and I put it into my business every year. So we had to downgrade our whole quality of life. We weren't traveling as much. We had to scale way back. You know how that goes, right? Then it came to a point where she's like, all right, you gotta, really, she was a motivating factor for us to fundraise.
Either do it or...
Yeah. And then, I began to fundraise through friends and family, because in the beginning, no one's gonna invest in your idea. It's just too much risk. And that's not even like a racial thing. Like, it's just too early for folks to buy in.
Absolutely.
So my funding helped us to get enough of an MVP to then get my first friends and family to invest as well, right? And so we started off first with trying to get cash. Like, hey, can you put in $5,000, $10,000 here? And that was hard. A couple folks did it, but then there was a turning point when one of my more successful investors was like, hey, I'll invest, but I'm gonna do it through a retirement rollover. And I didn't know what that was at the time, but that became a game changer.
Wow.
Because basically what he was doing was that he had his retirement funds. He wasn't using his real cash. He had a well-stocked retirement plan. Right. And so he's like, you know what? I'll give you $10,000. That's a small point percentage of what my overall thing is. Mm-hmm. It's risk. And the beautiful thing is that for him, which is what I came to learn, if we went belly up, he just writes off the loss against the gains in his retirement. Yeah. If we pay him back, it goes back into his retirement tax-free.
Right.
When I learned this,
it's a no-lose for him.
I was like, as long as you're managing the amount that you're putting in, it's a win-win. So I used that leverage to raise over $350,000 from friends and family, because my friends and family, they were, they're all in their mid-30s, so they had been working for some time, and they were like, well, I love the pitch, I love what you guys are doing, but I don't have the cash in my savings, and I'm just not going to give you my whole savings. And then when I told them about the retirement rollover, that was like, oh, well, of course, for the same exact reason.
Absolutely.
And that is what let us raise the friends and family money. It took us 2 years to do that. Mm-hmm. The average check size was $11,000, but we were able just to piece it together one by one and continue to take steps forward.
Yeah. So we're going to sit with this for a while, because this is a really unique vehicle. You don't hear this often in venture circles. I promise, right?
I'm gonna document this and tell it better. But
absolutely.
More folk, and especially people of color, need to know that this is a wonderful vehicle for the right investor to help you get going.
Absolutely, because as founders, we're watching TechCrunch and Crunchbase, and everyone raises $60 million. And
exactly, and we're in North Carolina, where
in a capital market that's constrained.
Exactly,
Absolutely right.
Those communities of investors are not here, and so it's, to me, I think that if you are in your 30s and your friends are in their 30s too, it can be a key way to help get you enough funding to get to your next milestone.
I'll also add that changes the risk profile of that investment too, because if you're in your 30s and you have a retirement account, you have time to make that up.
Exactly.
Right? As opposed to, hey, this was a major percentage of my net wealth, and I'm 50, and now I might as well just write it off.
Exactly.
It changes the risk threshold for investors. So I'm glad you brought that up.
Yeah.
And this is, I think, as significant a development as crowdfunding is. To be able to create this type of investment or develop your capital stack on investment capital from investment accounts, I think that just changes the game.
I never thought of that, and you can layer it with crowdfunding too.
True.
So you can do a crowdfunding raise and folks can still invest in that crowdfunding raise through their retirement rollover as well. So that's,
Yeah,
I'll probably do that.
right?
Next year. Don't be surprised to see that.
Yeah, I'll send you a bill. That's good consulting. But that does, it's so important because of what black founders have to deal with in terms of raising capital. And let's talk about that for a second. So, so I'm on startup number 5, 2 of which were venture funded. The other 3 we've been bootstrapped and also tapped into some non-dilutive capital. But the black founder experience is very different from the white male large metro experience. And let's just talk a little bit about the nuances there.
So I would first start off and frame the conversation that it's the same experience as still being black. Like it's the same thing. It's just that now it's in a different context. You know. So because I was thinking about this earlier today too, that it really just comes down to what I think most of us are told by our parents, that you have to work twice as hard to get just as far. Which it's good to have that context, but then it also means that you're getting half of the value of your time, right?
Absolutely.
So like, I see that is even extrapolated even further in the VC space to where, definitely. At least in corporate, it's more common to see people of color in a corporate place. You go to a regular job, you'll see other folks. You might see some black managers or Hispanic managers, but in the VC space, it's just not there at all. So we all as humans do pattern matching. We see success and we look for success, and then that is our default. So in terms of our realm, and especially with my raise that I'm even doing now, it's like I probably have to contact 4 times as many VCs to get the same result, which means I'm now getting a quarter of my value. But I live in reality, and to me, that is one of the benefits of being black and in America, is that very early on, we experience that the world is not fair, and we adjust.
Absolutely.
And that's just how it is. Like, it would be great if it wasn't, like if things were more equitable, but they aren't, so you just got to keep going forward. And it's the same thing with VC. So it's like, in terms of fundraising, I mean, this I was going to say, there's a major negative to raising capital the way that I did. My cap table has a lot more people on it than the standard VC would like. And so that means that now that I am raising, the overall story of my company has to be that much greater. Because 1, I'm black. 2, my cap table has more folks. Because most cap tables, as you know, they want to be like 3 to 8 people, maybe. Like they want that to be tight. They want to be 3 to 5, really. And here I am with like 30-some folks. But my story has to overcome all of these things. And it's just how it is. And so, I tell my team this, and the same thing I will have to tell my son. Like, no one is going to like save us or save you. You just have to outwork.
Absolutely.
And it's hard because you really can't outwork racism. But you have to keep working until you get to where you want to be.
Try to stay
exactly
as much as you can. And it's interesting too when we talk about the time and the effort investment as a black founder. There are behavioral barriers in venture capital as much as there are structural impediments. So if you look at structural impediments, the number of black VCs that you mentioned, or the dearth of black VCs, black-run funds and so forth, or black-focused funds.
Even black associates who look for deals. Like, we're at the top. Like, let's look at the bottom. Like, number of just employees who it is their job to find deals. That number is tiny.
Absolutely, it's minuscule, right? So, and in addition to those structural impediments, you also have the behavioral side of things, where we're dealing with a level of skepticism that the other parts of the venture capital environment and ecosystem don't necessarily. I remember taking a young lady to introducing her at a lunch to a venture investor. I knew she was a good fit for a space. He worked in that space for a great, had a number of investments in that space. And then as she started talking, now she had she had essentially side hustled herself into a really nice spot.
Yeah.
Was almost able to replace her day-to-day income with the business.
Yeah.
And so she's talking through, all right, I want to build a tool around it.
Yeah.
And I think it was the right point. So she was pre-MVP. But as she's talking, the investor started to correct her with little terms of art in the industry. As if to say, you know, you're not.
Really don't know what you're talking
you
about.
don't know what you're talking. And she knew everything. I mean, this woman was absolutely on point with the opportunity, with how she built around it.
Yeah.
She knew more about the industry and the market than anyone. But it was just this condescending, I know more than you. You're not using these buzzwords that we typically use in the industry. Therefore, this is kind of I disqualify you on that basis. And it was one of the most embarrassing for me because I made the introduction.
Of course.
But it was the most insulting thing for her to have to sit there and listen to that. And that's the type of dynamic on the behavioral side that we need to overcome to a large extent. So I mean, you want to talk about the behavioral part of it. I mean, there obviously the structural side, but the behavioral nuances that we deal with in the industry.
So there's this concept called Stereotype Threat. Have you heard of it before? You know, there was a great book that was written. It's called Whistling Valvede.
Yeah.
It's like a great read, although you can probably get the gist of it in like the first 3 or 4 chapters. But basically it speaks to anytime you think someone is stereotyping you, your brain becomes the multi-thread. And then he actually measured that the decreased impact on your capacity to execute is at least 25%.
Interesting.
This is a study that was done at Ohio State. Now this is racial. This is like
25%.
anytime you think that someone is stereotyping you, your brain is no longer focused on the task, but it's multi-threading, and that multi-thread is a decrease of your execution.
Sure.
And so in these circumstances, that's what we're dealing with the whole time, you know? So like what we do, we try and dress a certain way, we try and use the lingo, all to get to a point to where we can be just evaluated off of the value of the business or us as a person.
Absolutely.
And the sad thing is that it's just how it is.
It is.
There's that that is not a problem for me to change. Like I just got told a no from a VC. We just talked about it kind of off camera. And the commentary like showed that he wasn't really thinking through the same thing with this guy. And what I tell myself and what I would tell anyone else is that we just have to just stay focused on the mission. And I actually think that becomes a bit of a superpower. That is why we can be so resilient, because we deal with this daily. Like it's not the first time this woman has been spoken in this fashion.
Absolutely.
It's bad, but I'm speaking the matter of fact, like it happens regularly.
Absolutely.
And so, but the good thing is that for those VCs who can invest in us, you aren't just investing in someone with a good idea. You are investing with someone who is resilient enough to get to this point.
Absolutely right.
Like, I mean, if you want to talk about unicorns,
Right.
you have these unicorns of folks who will literally deal with the worst obstacles just to be successful.
Absolutely.
And when you talk about, especially, you know, seed stage and pre-seed stage, they always talk about the importance of investing in the founder.
Right.
What more do you need to see when you're dealing with founders who are willing to do anything, put up with literal condescending conversation just to be successful?
Absolutely. Absolutely. And another thing that that just mystifies me is how, for a data-driven industry, they tend to overlook that aspect. I mean, the statistics themselves say, for instance, that women founders return up to 30% premium on their investment, and black founders in a very similar.
That said with Harvard too was the same thing about how a diverse founding group, diverse founders will get you a higher rate of return.
Absolutely. So it is in many ways a bit of a I don't know. It's a little challenging in that regard.
I think that
to understand why there's such a dearth of availability.
The way that I view it is that we are all flawed human beings. And the reality is that because of that, we have to overcome those types of flaws. And so we just have to understand the climate. So like when I build my VC list of pitching, it's not 200 VCs, it's 800 VCs. So we just have to just understand that that's just the world that we live in. And in dealing in the reality, there's so much opportunity when you do that.
True.
I mean, you take what we are building at Freeman Capital, because we deal with the reality of the financial world overlooking a group of people or the population growth. It gives us an edge. So I would just encourage us to just focus on that edge and just stay laser focused on that.
So let's take the flip side of it. We talked about 2 VC engagements on the way in.
Yeah.
The second one, even though it didn't have the outcome that you desired, it was still valuable. You want to talk about that one?
Yeah, it was. And
why?
so the way that I look at no's is that, and because of my investing background, I look at it like even when you lose a trade, you can still learn something from that trade. And so in the no, when like they give you good no feedback, the no was actually like, it was, well, your business model, I get it, but I wonder, could you push it farther? And then if you can push it farther, that would mitigate my risk if I then invest in you. Now I take that feedback and think, well, maybe we can go farther. So like these no's, when you get good quality no's, when they've really thought through your business, they will literally help your business grow. And that's partially why I am here now, because some of the no's that we got early on, folks at Calvin, that's a bad idea. I told them, no, you're wrong. It's great. They were right, though. It was a bad idea. And then we got better. And then now some of those same investors, I mean, some of those same folks who told me no are investors. And so for me, I see value in the no's, because that is where you learn when you look at it as a holistic thing.
Absolutely.
The market is giving you feedback.
Absolutely. And a little bit of, I guess, personal sort of observing you throughout the years, too. You're very much a relationship manager, right? A relationship builder and a long-term relationship manager, right? Nothing's short-term with you. And I wanted to, one, recognize you for that, but also to know how important that is in this business, right? That even though you get a no, like that doesn't mean the relationship is over. And in fact, that changes the complexion of the relationship as long as there's great feedback and input. So
I mean,
thank you for bringing that up.
I think that when you talk about being a black founder too, like you have to find ways to stand out, right? A lot of folk, when they hear no, they go fine. They shut the door, like they leave, like you're wrong. I'm proving you wrong, right?
Right.
But whenever I hear no, and like even bad feedback no's, I'll still say like, all right, I saw your points. Here is my counter, and then here is where you can go to see me being successful. Because if I can be a outlier in their mind, then it's like, well, maybe I was wrong, and then they see more data points of success. They go, oh, let me jump on this before it's too late. And so a great mentor of mine said, jobs are short, careers are long. And so because of that, I just take it the perspective of that you just never know what can happen in 10 years, 20 years.
Very true.
And so just treat everyone right and be your authentic self, and you'll be in a good place.
Absolutely. Let's talk a little bit about the changes in the industry, in the startup ecosystem and VC over the last year or so. Let's quickly touch on that, because I think it's really important. We've gone through this social justice shift post George Floyd.
Correct.
A lot has happened.
Correct.
A lot of organizations have made commitments, some somewhat temporal, and some are very genuine and authentic. But let's talk about like what you've seen during this period.
So we've seen a lot of press releases. We've seen a lot of those, which are very good. That's a first step. I don't know how many allocations we have seen move to either the groups who have been doing this for years. So like it's one thing to say, hey, we are going to do this in the future, right? We're going to allocate X funds. There are already funds who have been doing this,
Absolutely.
have subject matter expertise, and are raising their next round.
Right.
So a quick fix would be to allocate funds. And so to me, I look at the press releases are great. It shows that you're aware, but what are the actions?
Absolutely.
Are you allocating more funds? Like, are you hiring more people? Are you helping to deal with the unconscious bias that we all have? Because this moment will pass. I mean, it's being triggered by the killing of black people, so I hope that stops and it passes. But people it depends on what action do they take. Like, a goal is not a goal unless there is a plan built behind it. And there are a lot of press releases without plans.
Yes.
Like definitive plans that like we can hold you accountable to, and that is the big thing for me. So I see that, I hope it changes. I study a little bit of history. We've been here for like 400 years. So I hope it changes.
But you're seeing a pattern.
But I'm seeing a pattern.
Right.
That's
Right.
my job to recognize patterns.
Absolutely.
And so I will control everything that I can, maintain those relationships, do good work, and hopefully those who are changing, that they'll go for it from there.
Yeah. And there's and much of what we've talked about is at the level of the analyst and the investor themselves. But I also think there's an opportunity for limited partners.
When they change, that is when things change.
That's when everything's going to change. Yes. When LPs demand that there be different allocations, then that's when, and when the incentive structure changes to match that.
Which, just for a second, we have to talk about this. This is not community service.
Right.
Where we are talking about the largest markets
Absolutely.
are going to be people of color.
Absolutely.
Like the income growth, the job growth, the entrepreneur, these aren't community service projects.
Right.
Like, there's real economic benefit in being diverse and inclusive.
Absolutely right. Absolutely right. All right. So where do we go from here? Where does the startup ecosystem nationally, or even on a micro scale, statewide, where do we go from here? What do you see in the near future? What do you hope for in the near future?
Well, I hope that, like you said, that the LPs are the ones that will start to change because they will push everything else down. And when you look at the structure of capital, from pre-seed to seed, and then you move forward on, what has to happen is that, one, black founders have to continue to execute. Okay. Because the number one way to get us more funding is to get exits and get wins.
Absolutely.
Then there's a new pattern to recognize.
Absolutely.
So when you look at the structure of capital, it comes from having great ideas, which get their seed funding, which then can leverage that funding, and the founder is surrounded with education and mentors to help them mitigate gaps.
Absolutely.
To then move up to hit that next Series A stage, because as they see more of that, that's when the successes come.
That's right.
And then at the Series A stage, then having mentors at that stage of growth to help you get to where you can go to a buyout, to a acquisition, or the dream would be an IPO, because I don't know if we have any of those.
That's a great question.
So. That's what has to happen, and part of that is dependent on the founder, and part of it is depending on who is supporting them in the investor.
Gotcha. For all of the nascent entrepreneurs that will hear this and see this recording, what's the best advice that you can possibly give them about how to deal both either with the industry or how to think about their startups?
The number one piece of advice that I would give is that be extremely present with the reality of the situation, both in terms of funding and the times that we are in. And then be extremely present and real with the weaknesses of your product. If a whole bunch, if every VC is not taking your meeting, then there's something wrong with your, the mail, or take that as feedback. If you can do those two things and iterate, be present with what's going on in the world, and then be super critical of your own idea, I think you will be successful. At least that's been my pattern.
Excellent. And I'll pull out two things from your story that I can identify with in mine. The first is a customer orientation, right? Know your customer base and know how to delight them, and try to figure out how to delight them. The second thing is, you mentioned early on in Freeman Capital, is getting an objective third-party opinion on the market. You did that super early, so much earlier than most startups do. And it's important, particularly for founders of color and women founders, to layer on credibility as much as possible from third parties to help alleviate some of those behavioral tendencies.
That's a great point. Yeah, that's a great point.
Excellent. Well, Calvin, man, it's always a
pleasure,
joy.
Man. Always a pleasure, man. We can do this for hours,
We could, and we probably will after this. great catching up with you.
For sure.
All the best with Freeman Capital. I know you're some major milestones that you're
Yes.
working towards. You've had some great wins. Google just made an investment in you guys.
Yes.
Congratulations.
Yeah, thank you much.
But I just wanted to say all the best to you, man. I wish you all the success in the world.
No, thank you so much, man. I'm happy that we can connect, and the same for you, man. I hope that for the next 20 years we'll do this some more. Man.
Absolutely.
Exactly.
Absolutely.
Exactly.
Thanks, man.
Thank you.